Welcome to the Investors Trading Academy talking glossary of financial terms and events. Our word of the day is ghosting. Ghosting is an illegal practice whereby two or more market makers collectively attempt to influence and change the price of a stock. Ghosting is used by corrupt companies to affect stock prices so they can profit from the price movement. The practice is illegal because market makers are required by law to act in competition with each other. It's known as ghosting because, like a spectral image or ghost, this collusion among market makers is difficult to detect. In developed markets, the consequences of ghosting can be severe. Ghosting is considered unethical because it violates the basic tenet of investing that assures reasonable competition among all money makers in the marketplace. When the value of a given stock is tampered with, either to increase the value or drive down the value, and cause investors to begin selling off the stock for less than the actual worth, it's impossible for investors to make decisions based on real information. As a result, the ability of the majority of investors to earn a return for their efforts is compromised, while a select few are in positions to profit from the price fixing. The name for this unethical and often illegal practice comes from the fact that everything is done in a clandestine and seemingly intangible manner. The general public, which includes the bulk of investors, is unaware of who's manufacturing this artificial change in the value of the shares involved, since the moneymakers will go to great lengths to remove any evidence that points to them as being involved in a price-fixing scheme. Their presence in the strategy is much like that of a spectre, hard to detect and even harder to implicate in the recent shift in the value of the stock.